Hello and welcome to this Prepare to Pass series on financial management. My name is Waleed and I teach this paper and the advanced version of this paper at PwC's Academy in Dubai. I'll put my contact email there just in case if you have got any questions after the webinar series is over today. You can always send me a note and I will try to get back to you ASAP. So some important links that we'll be using today. Both links will be important because we'll be doing some questions from the specimen exam questions and also some from the CB past questions. So if you can please open these links while we are going over the areas. So this was the plan. We're on to session 4 today. We've done something on investment appraisal, business finance, working capital, and now finally on valuations and risk management. We went through investment appraisal, some really good questions were there. We did 2 of them and some of them were homework. Then we did business finance where we also touched 2 questions, and then some of the really good questions I also chose for your homework later. And then we did working capital, a very good day on working capital where we looked at receivables, inventory, a bit of cash, a bit of ratios, working capital in general. And then there are a few questions there which you could have done as part of your homework. So some really, really good questions I have chosen for you to prepare for your March 19 exam. Finally, we are on day 4, which is focusing on valuations and risk management. As always, we will be going through the important areas, the important concepts on valuations and risk management. And once we're done with that, we will be going into some question practice on this area. Now, there's quite a long list of questions that I have chosen here for this webinar. Of course, we will not be able to do all of them, but we will be trying to do as much as we can covering these important areas. So, without wasting any time, let's go into the understanding part for today first, and then we'll go into some questions. Session 4. The first thing is we need to think about valuations. So in the first half, we will think about valuations, and then in the second half, we'll think about the idea of risk management. So within valuations, just to go over the concepts on this area, there are 2 sorts of valuations that we're going to see. One is equity valuation, and the other is debt valuation. So equity valuation and the debt valuation. Now, in terms of the equity valuation and the debt valuation, the first thing that we need to understand is that why are we interested in valuing equity, or why are we interested in valuing debt? Well, we're interested in them because we are going to buy or sell equity. So to buy or sell the equity, or to buy and sell the debt, what we need here is their market prices. So we are going to determine their market prices, because at these market prices we are going to buy or sell equity or buy or sell debt. So that is our overall aim here in this area of valuations. Now, the next thing is that we need to see ways in which we can find these market prices. What are the ways in which we can find these market prices? Now, there are a lot of techniques involved here. So I'll just do a little overview first. So within equity valuation, we look at 4 things, and within debt valuation, we'll look at 3 things. Within equity valuation, we'll look at ways like net assets. We'll look at the dividend valuation model. We'll look at PE method, and we will also look at a bit of free cash flow valuation, FCF valuation, free cash flows. FCF or free cash flows valuation. So these are the 4 ways we are going to look here to value equity. And then we'll look at debt, and within debt, we'll look at a redeemable debt valuation. Redeemable. We will look at irredeemable, and we'll look at convertibles. So this is our work cut out for the first half of this webinar. We're going to do a lot of things in terms of equity and the debt valuation. Now, in terms of the equity valuation, there are these techniques, and the aim will be to find P naught or VE. P naught, as you may know, is the share price now, or the price per share now, and the value of equity, the VE, is this. So we will be trying to find the share price now, or we will be trying to find the value of the equity. So let's go into the methods involved here. So I'll just do a little overview of these methods. The first one is the basic one. First one is the basic one, the net assets. Net assets. Total assets minus total liabilities. Total assets minus total liabilities. Value of equity of any business is simply its net assets, i.e. equity from SOFP. That is really, really simple. So any business's value of equity is simply its net assets, which are the equity from the SOFP. And remember, this equity from the SOFP is the book value of equity. It's the book value of equity. If the examining team wants you to find out the per share value, the P naught, then you take this value of equity based on net assets and divide by the number of shares. Now, remember, this area of valuations will be tested in section A or B of the exam. This is not a section C topic, which means that you may be asked to calculate a VE, you may be asked to calculate a per share value. So this is a section A or B topic, so you have to be careful what the examining team wants you to calculate here. So any business is worth its net assets. The value of equity is simply the equity from the SOFP, but this is book value analysis. And if you have to find the per share value, then you take the total value of equity, divide by the number of shares to find the per share value. Now, the second thing, the most important method for us is dividend valuation model, or DVM. Dividend valuation model. Very, very important method for us in terms of computing a business's value. Dividend valuation model. Now, when we think of dividend valuation model, we say that a business is worth its future dividends in perpetuity discounted at KE. So any business is worth its future dividends discounted at K. Future dividends in perpetuity discounted at KE. That is what the DVM method is trying to do. This is what the DVM method is trying to say. Now, it is important here that we see that how can we discount the future dividends at KE? Well, we have the growth model. Growth model is used for this. The growth model is used for this, which is P naught, D naught, 1 plus the G over RE minus the G. So that is the formula which is given on your formula sheets. So P naught is equal to D naught, 1 plus the G, RE minus the G. Now let's talk about these things out. What are all these things? So P naught, as we know, is the per share value. D naught is the dividends now. Or let me be more specific here and say this is the dividends per share now. Dividends per share now. G is the growth, and RE is the return on equity. So again, the same concept I discussed with you a few sessions back, that from the investor's perspective, it's a return. And from the business's perspective, it's a cost. So there's no difference in both, just a different way of looking at this. So this is cost of equity. It's cost of equity. So from an investor's perspective, it is RE. And from the business's perspective, it's a KE, which is a cost. It doesn't matter if you say RE or the KE, but be sure that you understand that what perspective are you looking at. If you're looking at from the investor's perspective, it's a return on equity. If you're looking at it from the business's perspective, it's a cost on equity. Now, this is the growth model, and this gives us a per share value. Now, going back to this explanation, a business is worth its future dividends in perpetuity discounted at KE. Well, this is exactly what we are doing here within this growth model. Please note that in this growth model, we are discounting the future dividends in perpetuity at cost of equity. It really surprises me to see the number of students who do not know that what is this formula trying to do. Well, this formula is trying to discount the future dividends in perpetuity at cost of equity. At cost of equity. Now, what we need to do next is to look at the idea of working out a value of equity from this. Now you can either take this P naught and multiply with the number of shares. And once you multiply it with the number of shares, you get a value of equity. You get a value of equity. This is one way. The second way is that within this growth model calculation, you can use total dividend now. Total dividend now, 1 plus the G, KE minus the G, and you will directly get a value of equity. And once you have got a value of equity, you can divide this with the number of shares to find the P naught or the per share value. So please be flexible in calculating things using both these ways. Be flexible in calculating things in both these ways, because we will be asked to either calculate a per share value, or we will be asked to calculate the value of the equity. equity. Now, any quick questions here on the DVM part? Any quick questions on the DVM part before I move on? Any quick questions you may have on the DVM part? Any quick questions on DVM part? Okay. Seems good. Number 3, the PE method of valuation. The PE method of valuation, which says that value of equity is simply multiple of a company's profit after tax, or the earnings is multiple of its profit after tax or the earnings. Okay. Now, what we're trying to say here is that value of the equity is profit after tax into a suitable PE ratio. A suitable PE ratio. So profit after tax into the suitable PE ratio. Now, the word profit after tax, again, in our syllabus means earnings. So what we do is we take any company's profit after tax and we simply multiply it to a PE ratio. Now, what is the calculation of a PE ratio? It is share price over EPS. Share price over EPS. Share price over EPS. Now, this suitable PE ratio is either the company's PE ratio or industry's PE ratio. The examining team will never give you 2. They will always give you 1 PE ratio, which you will have to use here as part of your valuation. Now, once you've got the value of equity, then you can divide this with the number of shares, and you will get a per share value. You'll get a per share value. Get a per share value. Then, if instead of the profit after tax in above calculation, I use EPS, earnings per share. How do we derive EPS? Well, we derive EPS from profit after tax. EPS is the profit after tax over the number of shares. If I take the EPS into a suitable PE ratio, what I'll get directly here is a per share value. And therefore, the per share value into the number of shares, we will get the value of equity. Again, these answers would be the same. So be flexible in whatever way you want to use here to compute these things. Yeah, there is no problem in terms of having or seeing different calculations. Now, that is the PE method of valuation, which is really, really simple, just a one-step calculation. And the final step, or the final method here is FCF valuation. FCF valuation, or the free cash flow valuation. Free cash flow valuation. Now, it's something really brief in our exam because it is mainly a high-level topic. So the advanced version of financial management focuses quite a lot on this area. But at this level of financial management, we are not going to look at very detailed calculations on FCF valuation. Rather, we'll just have a little overview we'll have a little overview of what this method is trying to do. A business is worth its future free cash flows discounted at KE or the WACC. A business is worth its future free cash flows discounted at KE or the WACC. Now, once you have a business's free cash flows and you discount these free cash flows at cost of equity, what you will get here is the value of equity. And if you have free cash flows of a business and you discount them at the WACC, you will have the value of the company or the value of the firm. So value of equity and value of company. And once you've got value of equity, then P naught is equal to value of equity divided by the number of shares. And then you've got the value of company as well, calculation. This is a very rare question in this exam, really. But I will highlight one question to you where this has been tested in the past, where it was simply that you had to take the free cash flows divided with the WACC to arrive at the value of the company. So this is how we value businesses using the free cash flow valuation. Now, these are the four methods we have seen on equity valuation. I'm happy to take any questions at this point. So if you've got any questions at this point, please feel free to send me your questions at this point. Any things, please send me your questions at this point. So the questions are coming in. The first question here is, what is a suitable PE ratio? Well, a suitable PE ratio can be a industry PE ratio, or it may be the buyer or the seller's PE ratio. So you really do not need to worry about having different PE ratios and choosing one. The examining team always likes to give one. So either it's industry, seller, or buyer PE ratio. Next question is, what is meant by market capitalization? Market capitalization is just another name for value of equity. Does PE ratio use market share price or current share price of the company? Well, market share price and current share price of the company are the same thing. So that is what we use in that. What is WACC? Well, WACC is the weighted average cost of capital, which we did on business finance. Next thing, could you repeat the P naught with EPS suitable P ratio? Yes, we can just go back to the P ratio a little. So to find the value of equity, we simply take the profit after tax into a suitable PE ratio. Profit after tax into the suitable PE ratio. Or we take EPS into a suitable P ratio. The EPS into suitable P ratio gives us a per share value, and profit after tax into suitable P ratio gives us a value of equity. So it's again just a different way of looking at things, really, whatever you may be asked to do in the exam. Okay. Any more questions here? Now, there was another question here that, can you tell us something about earnings yield? Yes, earnings yield. So earnings yield valuation. Earnings yield valuation is pretty much still part of the PE valuation. And what you need to know here is that earnings yield is inverse of PE ratio. Inverse of PE ratio. So again, how do we find the PE ratio? Well, we find it as share price over EPS. Share price over EPS. And the earnings yield ratio is EPS over the share price. EPS over the share price. Now, when we have got the earnings yield, then we have to look at the idea of just changing our earlier earnings valuation method a little. So when we use PE ratio, we say VE is equal to profit after tax into the PE ratio. Or we say that P naught is equal to EPS into the PE ratio. Now, once we are using earnings yield, which is the inverse of PE ratio, we can't say that we'll multiply with this ratio now. Then what we do is we say profit after tax divided by the earnings yield ratio. And to work out the P naught, we say EPS divided by earnings yield. The answers to both of these calculations will exactly be the same. The answers to both of these calculations will exactly be the same. Yeah. Just to show you that different ways of computing this and the answers would exactly be the same, I'm going to do a little quick example here. Let's imagine here that the share price is $10. EPS is $2. And the profit after tax is $100. So $100 is the profit after tax. Now, the first thing, if I had to do both of these valuations, the first thing here is I need to compute the PE ratio or the earnings yield ratio. So if we work out the PE ratio here, so let's work out the PE ratio, which will be share price over EPS, giving us a PE ratio of 5. And then if we have to work out the earnings yield ratio, it will be the EPS over the share price, giving us 0.2. So if I take $100 here and I multiply with the P ratio of 5, I'll get an answer of $500. And if I take the $100 and divide with the earnings yield of 0.2, if I take $100 and divide with the earnings yield of 0.2, I will still get the same answer, which is $500. So there is no difference here really in terms of the overall answer. It's just a different way of presenting the information. So if you're using a PE ratio, you always multiply with the profits. And if you're using the earnings yield ratio, you always divide with the profits to arrive at the value of the equity. So any more questions here on the equity valuations? Any more quick questions here on equity valuation before we move on? Any more questions on equity valuation? Okay, so this seems all okay so far. Let's just quickly go over a bit of debt valuation. Quickly over debt valuation. Now, when we think of the debt valuation, remember we're talking about the traded debt here. And there are three types of traded debt, which I covered previously on my business finance section as well. The three types of traded debt are redeemable, irredeemable, and the convertible. So redeemable, irredeemable, and the convertible. Now, redeemable debt is the one which will be redeemed, or the capital payment will be done at the end. Irredeemable debt is where we do not pay the principal, and convertible is where the debt is converted to equity in the future. Now, how do we use the debt valuation? We will find market price of debt. So our aim here is to find market price of the debt. Can anyone here who attended my session on business finance tell me that where did you see me using market price of debt on session 2? Where did you see me using market price of debt on session 2? So who remembers the point where we used the market price of debt on session 2? So where did we use market price of debt on session 2? So we saw the market price of debt calculation when we were trying to compute the value of the debt. And we said long-term debt from the SOFP divided by the par value of 100 into the market price of the debt. Market price of the debt. Now remember in session 2, yes, thank you for your answers, all right answers there. When we were thinking of the market price of the debt, this was given to us in session 2. But today, we will be finding this market price of debt. And once we'll find it, then we'll use it here in this calculation to find the market value of the debt. This is the market value of the debt. Yeah. Is that okay? Yeah. So this is what our aim here is. We have to find the market price of debt for the redeemable debt, irredeemable debt, and the convertibles. We have to find the market prices and then use it in the VD calculation. The question is how to find the market price. How to find the market price. How to find the market price of the debt. Well, it is not very difficult really, because what we're going to do is we find it by discounting future cash flows of debt at KD. By discounting future cash flows of debt at KD. Now there are three words here. Discounting, I'm sure we're all okay with discounting. Future cash flows and KD. So if you're okay with discounting, our aim here is to understand what sort of future cash flows and what is a KD. So future cash flows in terms of redeemable, irredeemable, and the convertibles. Now I need your help here because you know that we like to have interactive sessions where you also participate and it's just not me talking. So I want to know from you that what are the future cash flows involved when we talk about redeemable debt. So what are the future cash flows involved when we talk about the redeemable debt? So you tell me, what are the future cash flows involved when we talk about the redeemable debt? So some answers coming in. Interest and the redemption value. Yes, I agree with that. Thank you for these answers. So when we think of redeemable, we think about interest and the redemption value. Yeah, good, good, good. Yes, yes, I agree. Yes. The interest and the amount paid, that's right, yes. When we think of irredeemable debt, what are the cash flows involved here? So what are the cash flows involved here when we think of irredeemable debt? Cash flows involved when we think of irredeemable debt. Well, the cash flows involved are interest only. Thank you for your kind answer. It's the interest only. There is no redemption value when we talk about the irredeemable debt. Interest only, yes. Thank you. When we think of convertibles, the cash flows here are interest plus the redemption value or the conversion value. Redemption value or the conversion value, whichever is the higher one. Yeah, whichever is the higher one. So these are the future cash flows involved here. The next question is, how do you find the conversion value? The conversion value is number of shares which someone will get in the future by converting their debt to equity into the future share price. So number of shares into the future share price. So again, this information will be given to you in the question, that how many shares they would get in the future and what will be the future share price. And then you can simply find out the conversion value here. Okay. Once we're done with this bit and we have thought about the future cash flows, the next thing is to look at the KD. KD is the pre-tax cost of debt. Pre-tax cost of debt. Pre-tax cost of debt. Now, once we think of the pre-tax cost of debt, it is the return required by debt providers for giving or providing debt finance. Giving or providing debt finance. Now, one thing which really confuses so many students in this paper are the different names of KD, because KD has lots of different names. The KD has lots of different names. I'm going to put here 3 different names which the examining team can use in the exam to talk about KD. So one is KD, yes. The other is pre-tax cost of debt. But in addition to these, there are 3 other things which they can say, which are the KD. So it is also known as by the term yield. Yield simply means KD. It is also known by the term gross redemption yield, or GRY. It is also known by the term yield to maturity, YTM. And all these mean the same thing. So there is no difference in all these. So please never, never complicate things for yourself in the exam when the examining team uses different names of the same thing. So KD is the pre-tax cost of debt, which we know is the return required by the debt providers. Then there are different names for it, which are the yield, the gross redemption yield, and the yield to maturity. So what we are going to do in this area of debt valuation is we are going to discount the future cash flows of the debt. And now we know what are the future cash flows. We're going to discount them at this KD. So this is the discount rate. So we're going to discount them at this KD to find the market price of debt. And that is what our aim on market price of debt area is. So I'm happy to take any questions at this point before we go into some questions on the OT type questions on this area. So please feel free to drop me your questions right now before we go into some questions. Feel free to drop your questions at this point before we go into some questions. So the questions are coming in. Please explain asset valuation of equity. Well, there's nothing much to say there. It is simply the net assets of any business are its value, and the net assets are total assets minus total liabilities, which is simply the equity portion from the SOFP. So the equity portion, which you see in any SOFP of a business, is its net assets, and that is the value of that business. The other question here is, example of KD, please. Well, there is no example of KD as such. The example of KD is just that the return will be given to you in the question. So they'll say, well, the investors require a return of 5%, or the yield required by the investors is 5%, or the gross redemption yield is 5%. So you just know that this is the discount rate at which I'm going to discount my future cash flows of the debt. The next question is that for convertibles, do you discount the conversion value and not the redemption value of the loan? Well, what we said here is, we said that the cash flows here are interest and the redemption value or the conversion value. So this is an analysis which we have to do there and decide which is the higher value. So the higher value will come here. So if the higher value is redemption, you discount the redemption value. If the higher value is conversion value, we discount the conversion value. So it's a little decision that we need to do while thinking of the convertibles. So any other questions there before we move into doing some question practice on this area? Okay, so this seems all okay for now. Can I now take you into some questions? So what I will need now is the specimen exam link for now, the specimen exam link. So we are going to have a little look at the specimen exam link. So within this slide deck, there is this specimen exams link, which I want you to access, this link here, the specimen exams link, because we're doing some questions there. And within the specimen exam link, the first thing we're going to do is this question, which is bar question. So we are first going to do the bar question here, to do the bar question. Now, this bar question is from the specimen exam Q16 to Q20, which is a section B question on a bit of valuation. So if I can now take you, into the specimen exam. So full specimen exam. And within this specimen exam, now we will look at question 16, which has got a bit of valuation on it. So this is the question on hand, bar question. This is directly from the specimen exam. So I've not taken any PDF of this question because this is directly within the specimen exam. So you can access your specimen exam from the resources on financial management, or you can just work with me right now, and later on you can access the link of the specimen exam from the financial management resources. Now, here is a question, an OT question, section B type question for 10 marks. So again, remember, valuations topic can be tested in section A or B of the exam. So let's read the scenario here and then attempt 5 OT questions on this. So PAR currently has the following long-term capital structure. So we have their equity finance, which has got ordinary shares and the reserves. We've got some non-current liabilities, which are bank loans, convertible loan notes, 8%. So this 8%, remember, is the coupon. And then we've got redeemable preference shares, 5%, and the total value is 15. If I was to use the net asset valuation here, then the value of equity would have been $68.4 million. So $68.4 million based on book value terms would have been my value of equity if I was using net asset valuations. Just wanted to show you the figure which we're looking for in net assets. That is the equity portion from our SOFP. Now, the 8% loan notes are convertible into 8 ordinary shares per loan note in 7 years' time. So these convertibles, the 8%, remember, is coupon. It is the interest. And this is convertible into 8 ordinary shares per loan note in 7 years' time. If not converted, the loan notes can be redeemed on the same future date at their nominal value of $100. So if not converted, the loan notes can be redeemed on the same future date at their nominal value of $100, which means that the redemption value here is $100. The redemption value here is $100. PAR company has a cost of debt of 9% per year. So 9% per year is the cost of debt, and because there was no talk about tax here, so I'm assuming that this is the pre-tax cost of debt, 9%. So what is the role of this 9%? Can you drop your answers in? What do you think I will do with this 9% here? So what is the role of this 9%? Where is the cost of debt used? Where is the pre-tax cost of debt used? Yes, for discounting the cash flows. Discounting the cash flows. Yes, agreed. Well done. Discounting the future cash flows of the debt. That is where we use the pre-tax discount rate or pre-tax cost of debt, 9%. Then it says that the ordinary shares of PAR have a nominal value of $1 per share. So $1 is the nominal value. So if the total share capital is $30 million, and I know these are $1 shares in face value terms, then the number of shares here are 30 million. The current ex-div share price of the company is $10.90 per share. So current share price is $10.90 per share. So in simple terms, if you have to find the value of equity, you can also take number of shares into share price. So if that question is there, I can also calculate based on this, which is the market capitalization of the company. Number of shares times the share price. And share prices are expected to grow by 6% per year for the foreseeable future. Well, okay, so why is the examining team giving me this information about the share price being $10.90 and growing by 6% per year for the foreseeable future? Because they want me to think about the future share price. Remember, on the convertibles, we have to think about the conversion value. And the conversion value is the number of shares someone will get in the future into the future share price. The equity beta of PAR is 1.2. The equity beta of PAR is 1.2. So those who attended the session 2 on business finance, can you tell me which risks are there in this equity beta? So those who attended session 2 on business finance, can you tell me which risks are there in this equity beta? Which risks are there in this equity beta? Yes, so the answer is coming in now. Both business and financials. Well done. Well done. So you have done well with me on this revision webinar series. Yeah, thank you. So 2 risks there. Yeah, agreed. Yeah, business risk and the financial risk. Agreed, 1.2. Then, thank you for the answers. The loan notes are secured. The loan notes, which loan notes? Well, these loan notes. The loan notes, the convertible loan notes, are secured on non-current assets of power company. And the bank loan is secured by a floating charge on the current assets of the company. Floating charge on the current assets of the company. So if something is secured on, so both are secured debt. Something is secured on non-current assets, something on the current assets of the company. So if something is secured on the non-current assets, something on the current assets, which one is more safer? The one, so for the investors who provide the debt funding, if they get or give the loan note secured on non-current assets, or they give some sort of financing based on current assets, which of these will be more safe for them? The one on non-current assets or the current assets? What do you think? Non-current assets, because non-current assets are there for long term. Current assets may be just wiped out now. You may run out of your receivables, you may run out of your cash, you may run out of your inventory. So the safer option here is the non-current assets. So the non-current assets are safer option for anyone providing debt funding. Now, arrange the following sources of finance of power in order of the risk to the investor, with the riskiest first. So the riskiest first. So arrange the following sources of finance of power in order of the risk to the investor. Risk to the investor. Now, the risk to the investor. We talked about this earlier, that what is the most risky form of financing? Do you remember that? Which is the most risky form of financing? Which is the most risky form of financing? Yes, the ordinary shares are riskiest. So the most risky form of financing is ordinary shares. So that comes first. Then the preferred shares are also part of equity. So preferred shares would now come at second. They are part of equity. Now the question is, would I put the loan notes as the third risky or the bank loan as the third risky? So remember, we're going from high risk to low risk. High risk, low risk. So what is low risk? Is it the loan notes which were secured on the non-current assets, or is it the bank loan which was secured on the current assets? Yes, yes. So we are going to think of the risky part, which is the bank loan secured on the current assets. And the fourth is the loan note secured on the non-current assets, which is the safest. So high risk first, then low risk, then low risk, and then low risk. So loan notes were the safest because they were secured on non-current assets. And the bank loan is more risky than the loan notes because it is secured by the current assets. And the floating charge means just a variable rate on the current assets. Now, so this was the risk part of the yes, so right answers. Thank you for all the right answers. This was a good question, thinking about the sources of finance. Let's go to question 2. Text box question. So calculate the conversion value of the 8% loan notes of power company after the 7 years. So we have to find the conversion value to 2 decimal places. Conversion value to 2 decimal places. That is what we have to find out. Now remember, in section A and B of your exam, you will not have access to a spreadsheet. You will not have access to a spreadsheet for section A and B of the exam. So what you can do is you can do your workings on a piece of paper or the scratch pad given to you in the exam, using a calculator, and then put your final answer in the text box. So going back to my PDF, where I talked about the conversion value, remember the conversion value is number of shares into the future share price. Number of shares into the future share price. So looking at question number 17. Question number 17. And we are trying to find out here the conversion value. Conversion value, which is number of shares into future share price. Now, how do you find the future share price? Well, the future share price is the current share price into 1 plus the growth to the power of n, which is the number of years, and that gives you the future share price. So from this question 17, can you now tell me how many shares would these people or the investors get in the future? So if they decide to convert, how many shares are they going to get in the future? So how many shares are they going to get in the future? How many shares were they going to get in the future? How many shares would they get in the future? Yes, 8 ordinary shares. Yes, right answers. Thank you. They will get 8 ordinary shares in the future. So we'll take 8 as the number of shares into the future share price. So what is the current share price here? The current share price is 10.90. The current share price is 10.90. 10.90. And the growth rate in the share price is 6%. Is 6%. So 1.06. After how many years would this decision be made? After 7 years. So the decision would be made after 7 years. So if you now try to solve this, you will have the conversion value. You will have the conversion value. So if you can just do this calculation on your calculators, you should have the conversion value, which should come out to be 131.12. It should come out to be 131.12. Yes, right answer. Remember that the examining team is going to give us the number of decimal places they want us to work out the numbers. And this decimal places is 2 in this question. So 131.12. So the correct answer here is 131.12. That's how we work out the conversion value. So 131.12. Yeah. So number of shares 8. Future share price, current share price into 1 plus the g over the number of to the power of number of years, 131.12. Then third one, assuming the conversion value after 7 years is 126.15. So assuming the conversion value of the shares is 126.15, what is the current market value of the 8% loan notes of Par Company? So assuming the conversion value is 126.15, what is the current market value of the 8% loan notes of the Par Company? So we have to do this working now. Question 18. Question 18. So the conversion value given now is 126.15. And they're asking for market price. So what are we going to do here is discounting future cash flows of the convertible debt at the KD. So here, cash flows, discount factor. So the discount factor in this question here was 9%, remember? And then the present value. So the timing here of this debt was from 1 to 7. And for 1:7, you've got the interest. What was the interest on the convertibles? What was the coupon on the convertibles? What was the coupon on the convertibles? What was the coupon on the convertibles? Yes, the coupon here was 8%. So that means $8. So we apply the coupon on the par value, and the par value of debt is always 100. The interest is $8. And in year 7, the conversion value is 126.15. 126.15. So now we are going to discount these at the 9%. Sorry, we're going to discount these at the 9%. Can I ask you to kindly put in the discount factors and give me the market price here? So the discount factors and the market price here. So we need to put in the discount factors at 9%. So tables. So discount factors at 9%. So first is 9% annuity for 7 years, which is 5.033. 5.033. This is 5.033. The 9%, 7 years worth of annuity. Then the 9% discount factor for the 7th year, 9% discount factor for the 7th year, which is 0.547, 0.547. So once you do the maths here, I can then have the market price of this. I can have the market price of this. So $8 into the 5.033, we get 40.26. This is 40.26. And then 126.15 into 0.547 will get 69. And once we'll add these two, we'll get 109.26. 109.26. So that is the market price that we got here, 109.26. So if I go back to my Kings, yes, here is 109.26 as the answer. So just going over this calculation again, and I've done nothing differently here, to be honest. I've just taken the interest, which was the cash flow, and discounted that at 9%, and I took the conversion value and discounted that at 9% as well to find the market price. So that was 18. Next question. Which of the following statements relating to the capital asset pricing model is correct? So which of the statements about the capital asset pricing model is correct? The equity beta of par considers only business risk. Well, you already gave me the answer to that, but the equity beta has two risks, business and the financial risk. So this is not right. The capital asset pricing model considers systematic and unsystematic risk. No, because the CAPM model is built on the systematic risk only. And we assume that the shareholders are well diversified away, which means the unsystematic risk is zero. The equity beta of par indicates that the company is more risky than the market as a whole. Well, this seems right because this 1.2, we always compare the beta to 1. So 1.2 here means that the company's is more risky as compared to market. So 1.2 does mean that they're more risky as compared to market. The debt beta of par is zero. There was no talk about the debt beta in this question, so it's just irrelevant. So this was the right answer here, that the equity beta of par indicates the company is more risky than the market as a whole. Then the 20. Which two of the following are problems in using PE ratio method to value a company? which two of the following are problems in using the PE ratio method to value a company? So there are two problems here. So which two of the problems are there? I want you to read this. It is the reciprocal of the earnings yield. Well, is it a problem really? Well, no, it's not a problem. It's just a fact that yes, PE ratio, it is the reciprocal of the earnings yield. It combines stock market information and the corporate information. Well, yes, we get the stock market information from the share price, corporate information from business's profits. So that's a fact as well. It is difficult to select a suitable PE ratio. Yes, because as I said earlier, you can use the industry's PE ratio. You can also use the business's PE ratio. And then the question is which one to use? Well, in the exam, we won't have that problem because only one would be given. But in reality, it may be a difficult thing to decide that which PE ratio you're going to use. The ratio is more suited to valuing the shares of listed company. Yes. So listed companies which have got a transparent share price coming in from the stock market, the PE ratio is more suitable for them. Because in a private company, the share price won't be transparent, won't be having the full the full value which we get off from a stock market company. So it's more suitable to listed companies who have got a share price coming in from the stock market. So these are the two things about the PE ratio, which were the problems. Now, any questions here? Any questions here on this PAR question before we move on? So I'm happy to take any questions on the PAR question so far. So any questions here on the PAR question? Okay, so it seems all okay on the PAR question. So a few things coming in. Sir, the CV calculated is just for one loan note. Yes, it is for one loan note. Convertible value calculation once again. Well, the convertible value calculation. Here is the convertible value calculation, or the conversion value, number of shares into the future share price. Okay. Just one more question on valuations before we go into risk management. Can I ask you to go into the September 16 exam now? So the September 16 exam, which would be on the CBE past exams link, September 16, CBE past exams link, September 16. And within September 16, we're going to have look at question 21 to 25. Question 21 to 25. So that would complete this. It would also complete this for us. So question 21 to 25 on September 16. Okay, so 21 to 25. That's another section B question. It's the ring company, and we have got some OT questions attached to it. So ring has in issue ordinary shares with a nominal value of 0.25 per share. The face value is 0.25. These shares are traded on an efficient capital market. It is now 20x6 and the company has just paid a dividend of 0.450 per share. Recent dividends of the company are as follows. So if the examining team is giving you the X6 information and also the past dividends, This information will help us to work out the growth rate. And the model we're going to use here is the historic model. Ring also has an issue loan notes which are redeemable in 7 years' time at their nominal value of 100 per loan note, and which pay interest of 6% per year. So the coupon is given, timing is 7 years, and the redemption value is $100. About this note. The finance director of Ring wishes to determine the value of the company. Ring has a cost of equity of 10%, and the before tax cost of debt is 4%. So this is again the discount rate, 4% pre-tax cost of debt. The company pays tax at 25% per year. Using the dividend growth model, what is the market value of each ordinary share to 2 decimal places? Now, my first question to you here is, do you think that the examining team wants us to work out the per share value or the value of equity? Do you think they want us to work out the per share value or the value of equity? Yes, it is the per share value. So it's a per share value that we have to work out. Now, if by mistake you work out the value of equity here and you put your answer, that would be considered wrong because the answers fed into the system are the per share value answers. So let's try and do this. Yes, thank you for the right answers. Thank you for the right answers. Just a quick question here. Will we be provided with a physical plain paper? Yes, you will need to ask for it, and you should have a piece of paper to do your workings. And you also have the scratch pad in the exam to just manually input your workings on a scratch pad. And that scratch pad will remain there. It doesn't go with your answer. So let's try and do this question, the 21 ring. The model we are using here is D naught, 1 plus the G, KE minus the G. There are 3 things we need here. There are 3 things we need here. We need information about the dividends, we need the growth, and we need the KE. Do we have the current dividend here? Yes, we have the current dividend, which is 0.450. Do we have the growth? We'll need to find it. Do we have the cost of equity? Yes, we have the cost of equity as 10%. 10% cost of equity. Now, what we need to do now is we just need to work out the growth using the historic model. So what is the current dividend? So historic model D naught over dn 1 by n minus the 1. So those who attended again the business finance session 2, you would know that this is the historic model. Let's input the values. The dividend now is 0.45. The past dividend here is 0.370. This is the past dividend. The 20x2 value given 0.370 past. 0.370. How many years is the data here? So from x2 to x3 is 1. From x3 to x4 is 2. From x4 to x5 is 3. And from x5 to x6 is 4. So we've got 4 years worth of data here. So 1 by 4 minus the 1. So let's work this out. What do we get? So we will get here. Yeah, so we get 5%. So we're getting here 5% as the growth. The 5% is what we're getting here as the growth. So once you've got the 5% growth here, now it's just a matter of inputting all those values into that calculation. So what we can do now is, therefore, the 0.45, 1.05, which is the growth, The cost of equity was 10%, 0.10 minus 0.05, and this will give us our per share value. So if you work out this per share value now up to 2 decimal places, so working out this at 2 decimal places, we should have $9.45. So $9.45 is what we should have, thinking of the 2 decimal places. $9.45. Any questions here on this one? So good question on DVM, which we get $9.45. Any questions up to this point on this area? So we worked out the G. After working out the G, we put in the values to find the 9.45. So 9.45. Okay, all good. Next is, what is the market value of each loan note? What is the market value of each loan note? What is the market value of each loan note? Let's read the loan note information again. Loan note in issue, which is redeemable in 7 years' time. Nominal value of 100. Interest is 6%. So let's do the workings on this one then. 22. So first, thinking of what information is there. Coupon is 6%, which means on $6. The KD, the pre-tax cost of debt, is given here as 4%. And the time is 1 to 7. Redemption value is $100, redeemable at nominal value. So let's try and do this. Yeah. Cash flows, discount factor at 4%, and the present value. So from year 1 to 7, we've got a cash flow of $6. In year 7, we've got a redemption value of 100. And what I would like to request now is for you to discount these and find the market price. I would like you to discount these and find the market price. So let me put in the discount factors for you. So 4%, 7 years, 0.760, 0.760. And the 4% annuity factor, so 4.4% annuity factor, this would be 4%, 7 years annuity factor, 6.022, 6.002. So once you will solve this, can I have the market prices here? Can I have the market price of this redeemable loan note? So what do you get as the market price here? Yes, 112 is the market price. And do we have an answer there? Yes, 112.01 is the market price here. 112.01. Now, the next thing here is that we need to be able, yeah, thank you for the right answers. 112, yes, agree. So this is it. This is the market price of the debt. Next question now. Quickly, let's just finish this off. The finance director of Ring has been advised to calculate the net asset value of the company. To find the net asset value of the company, which of the following formula correctly calculates the net asset value of Ring? Total assets less current liabilities? No. Non-current assets plus net current assets? No. Non-current assets plus the current assets less the total liabilities? Yes. So that's the total assets minus total liabilities. and then non-current assets less none. No. So it's the third one. Third one is the correct one here. Net asset calculation. 24. Which of the following statements about valuation methods is true? The earnings yield method multiplies earnings by the earnings yield. So when we use the earnings yield, do we multiply or divide? Well, we divide, so this is not true. The equity market value is the number of shares multiplied by share price plus the market value of debt. No, the equity market value is simply number of shares into the share price. That's not right as well. The dividend valuation model makes the unreasonable assumption that average dividend growth is constant. I think that's right, because we assume that the growth rate in perpetuity will be the same. And the PE ratio method divides earnings by the PE ratio. No, in the PE ratio, we multiply with the PE ratio, not divide. So 3 is the right one here. The dividend model assumes that the growth will be constant. 25. Indicate by clicking on the relevant boxes in the table below whether each of the following statements about capital market efficiency are correct or incorrect. So there are some informations here. Okay, which we need to see in terms of the capital market efficiency. Insider information cannot be used to make abnormal gains in a strong form efficient capital market. Insider information cannot be used to make abnormal gains in a strong form capital market. Well, that is true. That is true. In a weak form efficient capital market, Ring's share price reacts to new information the day after it is announced. Is it right? No, because in a weak form, we only consider the past information. And once it has taken the impact on share price doesn't change to the same information again. Ring's share price reacts quickly and accurately to new released information in a semi-strong, efficient capital market, correct? Because in a semi-strong capital market, we know that we are looking at the past information plus any published information. So as soon as the published information comes, the share price reacts to that. So that's correct. The problem with this one is that in the weak form, once the share price has reacted to past information, it doesn't react again. And insider information, as we know, cannot be used to make gains in a strong form efficient capital market. So these were the questions here, and it also helped us to revise a bit on the market efficiencies. And that's it on the 5 questions on this. That is it on the 5 questions. So any quick questions here, I'm happy to take, but I would just stop here. I would just stop here for about 3 to 4 minutes. And within this time, I'm happy for you to bring in any questions that you may have. And once I come back, I will answer these questions on valuations, and then we will go into risk management. So like a 4-minute break maybe. And within these 4 minutes, I would like you to put your questions here. So break, and we will resume in 4 to 5 minutes, and I will wait for your questions. Yes, so we're back. So some questions here. Let's think of it. Um, what is a weak form efficiency? Well, weak form efficiency is basically where we've got only the past information. Um, there is use of insider information. Well, we can't really use it to have any gains. Um, the gross redemption yield calculation, only one example, please. The gross redemption yield calculation. Can we use any discount rate in calculation of IRR to find negative or positive NP? Well, you can use any discount rate. Discuss a little bit about efficient market hypothesis. We don't have much time on that really, but the only thing which I will discuss here is that there are three forms. There is weak, there is semi-strong, and there is strong. Weak market only has past information. Semi-strong has past plus the published information. And the strong form has the past, published, and the private information. But care must be taken that you're not taking this information to make any use of for any personal gains. The share price reacts, and then that's it. It doesn't react again in the future. Share price reacts, and not in future. When we think of semi-strong, the share price reacts to new information. And then we will, of course, the strong, where the problem is that you should not be using the private information. Private information is sensitive information, and it is not allowed by law to use that information to make any sort of gains. So this is all on valuations. Let's just focus next. There was also a question asking for the calculation of the KD, to show the calculation of KD. Well, we already did that on business finance. So if you go back to session 2 on business finance, we calculated the KD1 minus the T of the redeemable debt. And that is the KD. So all KDs we did there. So once you ignore the tax part, the remaining part is just the KD. So please watch the session 2 business finance again on that. Now, the last thing here is the thing on risk management. Risk management. Now, within the risk management, what we are thinking of here is the idea of currency and the interest rate risk management. Currency and the interest rate risk management. First of all, in the currency risk management, we need to think about the risk. The risk here is that the exchange rates move in a way that we get a loss. And in the interest rate, the risk is that in borrowing scenarios, the interest rate will go up, and in the deposit scenarios, the interest rate will go down. And what we are going to try and do here is we are trying to hedge this. Hedge this. And the word hedge means to reduce the risk. Reduce the risk. That is what the word hedge means, reduce the risk. Now, the bigger portion here is, of course, the currency bit. And there's a very small portion of interest rate. So time permitting, we will see what we can do best. But first of all, let's think about currency. Currency risk management. Now, I will be covering few of the techniques using the questions that we're going to do today, but I just want to tell you that what are the main methods involved in our syllabus with which we can solve this. So first is forwards, money market hedge, a bit of futures, options, and swaps, the currency swaps. Now, what we are going to do in our exam is that we will have the calculations on these two areas. Calculations on these two areas, forwards and the money market hedge. Forwards and the money market hedge. We won't have any calculations on these. And the reason is because these areas are high level. They are much more examined in the advanced version of this paper. So what is examined here in terms of numbers is just the forwards and money market hedge. So with some questions today, I will see how to deal with some futures, options, and swaps as well. But that is not the most important area for us because it is a bit non-core within this. The important area for us is to be really good with forwards and money market hedge because that is where more marks are available. So we will touch on all of them, but more work on forwards and the money market hedge. So first of all, what are the forward contracts? Forward contracts. Forward contracts are such contracts which fix a rate, an exchange rate, to be used in future. Fix into an exchange rate to be used in future. They are legally binding contracts. They can be customized. They can be customized based on amount and timing. They can be customized based on amount and the timing. Yeah, they can be customized based on amount and the timing. So you decide how much amount you want to hedge and you decide how much time do you want to hedge for. So on that basis, they can be customized. So these are forward contracts. Now, forward contracts are really easy once we have the understanding of the exchange rates. Because once we have the understanding of exchange rates, then it's just a matter of taking the correct rate from the given information and using that in our answers. So we just need to understand the exchange rates because once we know how to pick the right exchange rate, the forwards are really, really easy. So I'll do some examples. Example. Let's say that the rate today is $1.50 per pound. The transaction on hand is $100. The home is the UK and abroad, or the FX, foreign currency, is the US. Can I ask you to please convert this transaction and tell me how much would this be in pounds? So I'm going to take some answers here. So can you convert this transaction into pounds and tell me how much would you get? So what would you get if you convert this into pounds? Yeah, so I'm getting some right answers here. 67 or 66 seems to be right. So the answer here is 100 over 1.5, 67 pounds. Now, there are two ways to look at this, right, so that you don't make a mistake in the exam. First of all, let's look at this quotation. It means $1.50 equals to £1, which means when I will have the pound answer, the pound answer would always be less than the dollar answer. I'm not talking about the currency's value. I'm talking about the number itself. So the pound answer would always be less than the dollar answer. So if I have a dollar transaction of $100, that means the pound answer should always be lesser. So it will only become lesser once I will divide with 1.5. Because if you multiply with 1.5, you get a bigger answer, which would be wrong anyways. Yeah, so £67. The other way in which you can look at this is using a bit of a memory aid. That is, if the rates are quoted, if the rates are fx/home, if the rates are fx/home, we always divide with the given rate. So if the rates are fx/home, we divide with the rate. If the rates are fx/home, we always divide with the rate. So here is the foreign currency, fx, and here is the home. So this rate was given in such a way that the fx was on this side, the home was on this side, which means that we can divide with this rate. So that is the thing you need to remember. If the rates are fx/home, we always divide with the rates. Okay. Now, another example here. Sometimes the examining team gives us a rate in this way. This way. So $1.50 per the pound plus minus 0.0050. The transaction is $100. Receipt. Foreign is the US. Home is the UK. So sometimes we get the rates in this way as well. Now, when we get the rates in this way, the first thing is we should be able to expand this rate. We have to expand the rate. The first thing is expand the rate. How do we expand the rate? First, we deduct this spread. So this is called the spread. This is a spread. So first we deduct the spread and then we add the spread. First we deduct the spread and then we add the spread. So what we'll do is we'll take $1.4950. So from the 1.5, we have now deducted the 0.0050. So we get 1.4950 and then add, so 1.5050 per the pound. So this is now the expanded rate. This is the expanded rate. First we deduct the spread and then we add the spread. First deduct the spread. So first you deduct the spread and then you add the spread. So first deduct and then add. So the expanded rate is now 1.4950, 1.5050 per the pound. Now, if you have a receipt coming in of $100, if you have a receipt coming in of $100 for you as a company, which rate would you use to convert this? Now, remember, these are the rates given by the bank. These are the rates given by the bank. So which rate are we going to use to convert this receipt into our home currency, which is the pound? So that is the question, which is for you now. Would we use the 1.4950 or would we use the 1.5050? Would we use the 1.5050 or the 1.4950? Okay, so mixed sort of answers coming in. Yeah, majority are on the right answer. Yes, Okay, well done. I'm really, really good. What we're going to use here is this rate, because in this scenario now, the bank is going to buy the dollar and sell the pound to us. The bank will buy the dollar and sell the pound. Now, if they're going to sell us the pound here, which is the home currency, are they going to sell us at the low rate or the higher rate? Well, the bank always sells at the higher rate. The bank buys at the low rate and sells at the higher rate. So the bank buys at low and sells at high. Bank will always sell at high rate, i.e. 1.5050. Yeah. So that's one way of looking at this. Now, I've also got a quick memory aid here for you to quickly do this one. The quick memory aid here is this. If the rates are in FX/home format, if the rates are in FX/home format and we are receiving, we always use the right-hand rate or the higher rate. And if it's a payment, we always use the left-hand rate. So on this example again, this works well. I knew here that the dollar was my FX. I know that the pound is my home. So if the rates are quoted as the dollar per the pound or the FX/the home format, receipt right hand. So this should have been the right hand rate here to use for this receipt, and the payment left hand. Just remember these two quick memory aids to make your life easier in the exam, and do not please complicate this area. So if the memory aid is, if the rates are FX/home, we always divide. And then if the rates are FX/home and the rates are in this way, which is the above quotation, then receipt right hand and the payment left hand. Yeah. Yes, right answers. Thank you. So this is what we need to know in exchange rates, and we will then do some questions on it. But just before we go into some questions, something on the money market hedge. Within the money market hedge, it makes the conversion. It makes the conversion at today's spot rate. That is the key part that we need to know when we're thinking about the money market hedge. The conversion takes place at today's spot rate. Now, there are two scenarios here which I want you to make a note of, or there are two structures I want you to make a note of: the payment structure and the receipt structure. So the payment structure, you put your foreign currency here, you put your home currency here. Remember, the examining team will always give you the foreign currency as the in the scenario, and you'll have to convert it to home. I use a three-step approach. And this is structure I want you to make here. Do not worry about the numbers yet. Just make the structure here first. So we start from here. The first thing is we divide with the 1 plus the I, and we get our answer here. Now this I here is the deposit rate abroad. This is the deposit rate abroad, FX, deposit rate abroad. Then once we've got the answer here, we use the spot rate, which is the today's spot rate, and we convert it into home. And once we've converted this into home, then we multiply that with the 1 plus the I. And I here is the borrowing rate in home. Borrowing rate home. So do not worry about the numbers yet. I just want you to think about the structure. So three-step approach. The first step is we take the FX amount, divide by 1 plus the I, put our answer there, then use the current spot rate and convert it into home, and then finally into the 1 plus the I, and I is the borrowing rate in home. Okay. Now, the second structure is the receipt structure, which looks pretty identical. It's just a few changes in it. The receipt structure. We say FX, say home. One, two, three. The first step is still dividing this with the 1 plus the I, and I here is the borrowing rate abroad, the borrowing rate in FX. Put your answer here. Use the spot rate, convert it into home, and then into 1 plus the I. And I this time is the deposit rate in home, and get your final answer. So this is the structure that these are the structures that we're going to use here. These are the structures we're going to use here in order to do these calculations now. So this is the scenario on the money market hedge, the two structures. Keep them with you. So when I do the questions, I'll be using these structures. But before I jump into some questions, I'm happy to take few questions from you here. So any questions at this point before we go into some questions, the past questions? So any questions that you may have here, I'm happy to answer now. The question is, why have you written 1050 and not 1.05 in the first example? I think the first example I wrote 1.50 and not 1050. It was 1.50 as the exchange rate. What are more chances of risk management questions either in C, B, or A part of the paper? Well, risk management topic is going to be examined only in section A or the B. Section C will not have the risk management in terms of the currency and interest rate. So the currency hedge and the interest rate hedge will only be in section A or B of the exam. So in section C, we only get investment appraisal, business finance, and working capital. So any more questions before we jump into a few questions? Okay, so this seems all fine. Can I now ask you to go into a question called herd? Can I ask you to go into a question called herd? So herd question from the September 16 exam. September 16 exam, which is already open with me here. The question number is 16 to 20. 16 to 20, herd. So herd question. It also has a bit of interest rate parity. So let's just quickly go over that as well before we jump into this question. Also has a bit of interest rate parity. We can predict exchange rates. We can predict exchange rates in our syllabus. And the two models that we use to predict the exchange rate are purchasing power parity theory, and we can use interest rate parity theory. So purchasing power parity theory, which is built on inflation, and interest rate parity theory, which is built on interest rates. S1, S0 into 1 plus HC over 1 plus HB. The second scenario is F1 is equal to F0, or the spot rate now, into 1 plus IC or 1 plus IB. So let's think about these things here. S1 is the spot or exchange rate after 1 year, and S0 is the spot or exchange rate now. F1 is the forward rate after 1 year, and F0 is the forward rate now. is the forward rate now. HC is the inflation abroad, and HB is the inflation home. IC is the interest abroad, and IB is the interest home. So using informations in these calculations, we can simply work out the spot rates or the forward rates in future. So the theory which focuses on spot rates in 1 year's time uses inflation. The theory which asks us to predict the forward rates after some time is the IRPT. Now, again, if the examining team asks us to calculate, let's say, a 6-month forward rate, then we'll just take a half of those interest rates. So the interest rate abroad is 6%, take 3%. So let's have a look at this question then. Herd is based in a country whose currency is the dollar. The company expects to receive 1.5 million euros in 6 months' time from FindCo. So 1.5 million euros in 6 months' time is what we are receiving. A foreign customer. The finance director of Herd is concerned that the euro may depreciate against the dollar before the foreign customer makes the payment. And she's looking at hedging the receipt. So that is the risk that the euro depreciates and basically they will receive less. Herd has an issue loan notes with a total nominal value of $4 million, which can be redeemed in 10 years' time. The interest paid on the loan notes is at a variable rate linked to the LIBOR. So a bit of interest rate here as well. LIBOR is the interbank rate. The finance director of Herd believes that interest rates may increase in the near future. The spot exchange rate is 1.543 per $1. So spot rate now. The domestic short-term interest rate is 2% per year, while the foreign short-term interest rate is 5% per year. So here is information for you to do the interest rate parity. So information for us to do the interest rate parity. Now, what is the 6-month forward exchange rate predicted by the interest rate parity? So we have to use that interest rate parity calculation now. But remember, they're asking for a 6-month rate, not 1-year rate. Not 1-year rate, the 6-month rate. So we need to do that calculation, thinking about the 6-month rate here. So if we are ready, we can go into the interest bit part of it. So let's do the workings on this. This is the question 16. Interest rate parity. So we are going to use IRPT to find the F1, which is the spot rate now. So F0 or the spot rate now, into 1 plus IC over 1 plus IB. So interest abroad and interest home. Now, can I ask you, first of all, to tell me here, what do you think is the interest rate abroad in this question? So what is the interest rate abroad? So what is the IC in this question, which is given to us? IC, interest rate abroad. What is the interest rate abroad in this question? So if you look at the last paragraph, what is interest rate abroad? Yeah, so foreign short-term interest rate is 5%. So foreign short-term interest rate is 5% per annum. 5% per annum. Yeah. So what would be the 6-month rate here? The 6-month rate will be 2.5%. And what is IB? The interest rate in home. The IB is interest rate home. The domestic short-term interest rate is 2%. 2% per annum, which means this would be 1% for 6 months. These are the 6-month rates. Once we've done this, therefore, we can take the current spot rate, which is given as 1.543, 1.543 into 1.025 over 1.01. So this is our calculation. And if I solve this on the calculator, we'll get here the answer as the 6-month forward rate. So the 6-month forward rate here calculated will be 1.566 per the dollar. So that is our 6-month forward rate calculated based on interest rate parity. A question to you here: what if the examining team asked us for 1-year forward rate? What would you have done differently in this working? So if the examining team here asked for a 1-year forward rate, what would you have done differently here? A 1-year forward rate. What would you have done differently here? If the examining team asked us to calculate a 1-year forward rate. Yes, correct answers again. We would have used 5% and 2% in that case, the 5% being the annual rate and 2% being the annual rate. So that's all good. So 1.566, which is here as the right answer. Next one now. As regards the euro receipt, what is the primary nature of the risk faced by Herd Company? So is it a transaction risk? Is it resulting from a transaction? Is it an economic risk resulting from macro factors? Is it a translation risk where the assets and liabilities are converted into the home currency at the year end? Or is it a business risk resulting from operations? Well, this is a transaction risk. Yeah, this is a transaction risk. So they're going to receive from a customer 1.5 million. So it is a transaction risk. Next, which of the following hedging methods will not be suitable for hedging the euro receipt? So there's one method here which will not be suitable for hedging the euro receipt. Well, we can use the forwards. I don't think there's a problem with that. Money market hedge, yes. Currency futures as well, but not the currency swaps, because remember, currency swaps are a long-term hedge. So if it's like a 6-month transaction, we can't use the currency swaps for it. Currency swaps are not suitable for shorter transactions. They are long-term hedge. So the other methods are fine, but the currency swaps are not the valid way. 19 then. Indicate by clicking on the relevant boxes in the table below whether or not each of the following statements supports the finance director's belief that the euro will depreciate against the dollar. Euro will depreciate against the dollar. Okay. Now this question is a complex one to deal in exam situations. So what I need here is a bit of numbers. I need a bit of numbers here. So by clicking on the relevant boxes, whether or not each of the following statements supports the finance director belief that the euro will depreciate against the dollar. So I need some simple numbers here. To talk about this, we need simple numbers. 19, put simple numbers. Let's say the rate given in the question, which I'm going to use, the spot rate euro, 1.543 per the dollar. This is the rate. The first scenario is that the dollar inflation rate is greater than the euro inflation rate. Dollar inflation rate is greater than the euro inflation rate. Which model uses the inflation to predict the exchange rates? That is the purchasing power parity theory. So dollar, remember, is the home and euro is abroad. So dollar inflation rate is greater than the euro inflation rate. So let's put simple numbers here. Let's assume that the euro inflation rate is 5% and the dollar inflation rate is greater, which is 1.07. I'm just imagining these numbers. Just making up numbers here. And what I've done is I have taken the inflation abroad as the lesser, 5%, and inflation home has the bigger rate. So the dollar inflation rate is greater than the euro inflation rate. So if I try to work this out on my calculator, so if we try to work this out on the calculator, let's see, what do we get? So 1.543 into 1.05, dividing that with 1.07. So what I get here is euro 1.514 per the dollar. 1.514 per the dollar. Now, what has happened through the euro here? Has the euro depreciated or appreciated? So can you tell me here, what has happened to the euro? Has the euro depreciated or appreciated? What has happened to the euro? Has the euro appreciated or depreciated in value in relation to dollar? Appreciated. The euro has now appreciated. So that means if the home inflation rate is more than the abroad inflation rate, the euro, which is the foreign currency, appreciates. This is appreciation of currency. Yeah, well done. So all giving the right answer. Well done. So appreciation of currency. So does this support the director's belief? No, it does not support the director's belief. Does not support the director's belief. Okay. Then, second, the dollar nominal interest rate is less than the euro nominal interest rate. Let's put the numbers here as well. So now if we do the same numbers, but let's say we're talking about the interest rate parity, IRPT, and they are saying that imagine that the dollar interest rate is less than the euro interest rate. So 1.07, the euro interest rate is higher, 1.05, the dollar interest rate is lower, and let's see what happens here. What happens here to the euro? So let's do this calculation. It's 1.543, 1.07, 1.05, 1.572, 1.572 per the dollar. Now, what has happened to the euro here? The euro has clearly depreciated. The euro has clearly depreciated. Yeah, it's depreciated. Now, if the euro has depreciated, which means that this supports the director's belief that the euro will depreciate against the dollar, but that will happen if the dollar nominal interest rate is less than the euro nominal interest rate. Question is how is the first one appreciating? Well, because previously we needed 1.543 euros to get $1, but now we need lesser euros to get $1, which means the euro is appreciating. Really good one, but really complex one in the exam. So please always work with simple numbers on such sort of questions. Last one here. As regards the interest rate risk faced by Heard, which of the following statements are correct? So again, we are doing a bit of revision of interest rates here as well. We don't have time to go into very detailed concepts on that, but this will help us. In exchange for a premium, Heard could hedge the interest rate risk by buying interest rate options. By buying interest rate options. This seems okay. Yeah, we can buy interest rate options and we have to pay a premium for it. Buying a floor will give Heard a hedge against interest rate increases. Buying a floor will give Heard hedge against interest rate increases. No, it's buying a cap which gives the Heard against hedge against interest rate increases. So 2 is not right. Heard can hedge its interest rate risk by buying interest rate futures now in order to sell them future. No, in borrowing scenarios, let's say we always sell the interest rate futures. So that's not right as well. Taking out a variable rate overdraft will allow Heard to hedge the interest rate risk through matching. No, it's not relevant statement. The only option here is this, that in exchange for a premium, the interest rate risk can be hedged. So again, we didn't have a really great chance to go over all these other areas, but I'm sure that on your tuition phase, you have gone through the interest rate futures, things like interest rate options. This is one of the few questions that you are going to see on this exam. A floor is a minimum rate, a cap is a maximum rate. So in this sort of scenario, a cap is what a company needs, where they can basically cap their interest rates. Now, just quickly, if I can move to another question on this. So I would like to now go into specimen exam. I'd like to go into the specimen exam, and the question is Zerona. So Zerona on the specimen exam. The specimen exam, Zerona, and the question number is 21 to 25. So 21 to 25. That's our last question for this session. Again, focusing on risk management, where we'll do a bit of forwards and money market hedge as well. So let's read this. 21 on specimen exam. Zerona, whose home currency is the dollar, took out a fixed interest peso bank loan several years ago when the peso interest rates were relatively cheap compared to the dollar interest rates. Zerona does not have any income in pesos. Economic difficulties have now increased the peso interest rates, while the dollar interest rates have remained relatively stable. Zerona must pay interest on the dates set by the bank, so that means they cannot deviate away from these dates. The same dates which the bank has given them, they need to pay interest on these dates. So no change is allowed there. Okay, then a payment of 5 million pesos is due in 6 months' time. So 5 million pesos is what they need to pay in 6 months' time. Okay. Then the following information is available. So we have the peso per dollar spot and the forward rates, 6-month forward rates. Remember, Zerona's home currency is the dollar. So the rates are quoted as FX/home. FX/home is how the rates are quoted here. The spot rate, we have the 6-month forward rate. When was the transaction due? The transaction was due, the transaction here is due in 6 months' time, 5 million pesos. Then we have the interest rates, the borrowing and deposit interest rates per year in peso and dollar for our money market hedge calculation. First of all, calculate the dollar cost of a forward market hedge to the nearest dollar. So first of all, we have to do the forward market hedge to the nearest dollar. So, okay, let's just think about this now. We have to use the forward rates. Here are the 6-month forward rates. And again, these are expanded rates, the left and the right hand rates. Can I ask you that if I have to convert the 5 million, I have to convert the 5 million pesos into dollars, which of these two rates I'm going to use? Do I use the left hand rate or the right hand rate here? Do I use the left hand rate, or are we going to use the right hand rate here? Would we use the 12.805 or the 12.889? So some answers coming in now. 12.805. Yes, right. 12.805, because what you remember from today's session is that if the rates are quoted as FX/home, which they are here, FX is this, home is this. If the rates are quoted as FX/home, and if it's a receipt, I'll use the right hand rate. But if it's a payment, I'll use the left hand rate, which is the 12.805. So let's just convert the 5 million. Let's just convert the 5 million into the dollar value. So 5 million dividing by 12.805. That gives us 390,472. 390,472. That is what we get here once we convert the 5 million pesos to the dollars at 12.805. Next. Okay, some more questions here like this. Indicate by clicking on the relevant box whether each of the following statements relate to interest rate parity only, to purchasing power parity only, or to both. The currency of the country with the higher inflation rate will weaken against the other currency. So which of the two models uses the inflation, or which of the two models uses the inflation? Is it the purchasing power parity theory or the interest rate parity theory? Well, it is the purchasing power parity theory which uses the inflation. So this is true. Yeah, right answers again. Thank you. Yeah, purchasing power parity theory. The theory holds in the long term rather than short term. Well, I think both the theories are true in long term because we are going to predict future exchange rates after 1 year. So both the theories hold true in the long term. The exchange rate reflects the different cost of living in two countries. The exchange rate reflects the different cost of living in two countries. So which theory says this? Is it the purchasing power parity theory or the interest rate parity theory? Is it the purchasing power parity theory or the interest rate parity theory? Well, again, it's the purchasing power parity theory because we're talking about the cost of living in two countries. Yeah. So the cost of living in two countries is stated by the theory of purchasing power parity because we're talking about the inflation here. The cost of living is the inflation that we're talking about. So unless or until the examining team doesn't use the word interest rates, do not self-assume. So here it was talking about the inflation. Next, 23. Okay, interesting. What are the appropriate 6-month interest rates for Zerona to use if it hedges the peso payment using a money market hedge? What are the appropriate 6-month interest rates for Zerona to use if it hedges the peso payment using a money market hedge? Now, what I will need you to do is to go to the structure where I was explaining to you the money market hedge, and on that structure, go to the payment structure. So in the payment structure, you remember that we deposit abroad and borrow home. We deposit abroad and borrow home. So in a payment structure, we deposit abroad and borrow home. So let's think about this. This is 23. The payment structure. We deposit abroad and we borrow home. What is abroad in this question? The abroad is the peso and the home is the dollar. So what is the peso rate? What is the peso deposit rate? Well, the peso deposit rate is 7.5% per year. The peso deposit rate is 7.5% per year. So that is the 7.5% per year. And what is the dollar borrowing rate? Well, the dollar borrowing rate is 4.5% per year. It's 4.5% per year, per annum. Now remember, they are asking us for the 6-month rates here. So what would you do to get the 6-month rates? You will simply multiply this with 6 by 12, multiply this with 6 by 12. So in the first scenario, in the 7.5 times 6 by 12, I'll get 3.75%. And if I do this one, 6 by 12, I'll get 2.25%. Now, this is how I've solved this, and I'll take the right options now. The borrowing rate. So what would be the borrowing rate here? The borrowing rate here is 2.25%. So the 2.25%, this goes in as borrowing rate. And what would be the deposit rate? The deposit rate here would be the 3.75. 3.75% as the deposit rate. And that's it. So we just got the right rates now here. The next question now, 24. Which two of the following are possible ways for Zerona to hedge its current foreign currency risk? Which two of the following are possible ways for Zerona to hedge its current foreign currency risk? Which two of the following are possible ways to hedge its current foreign currency risk? Can they do matching receipts with the payments? Can they do matching receipts and payments? Do they have any income from pesos in the scenario? Well, there was no income in the scenario, so we can't use this. Can we use currency swaps? Can we use currency swaps here? Could be used. Yes, we can use the swaps here because they are paying interest rate in long term. So the interest rates on long term, we can use the currency swaps for that. Leading or lagging? Leading is to accelerate exchange, lagging is to delay the exchange. We can't use that because the banks have set the dates which they wouldn't want to change. So we can't use that. Can we use currency futures? Yes, currency futures can be used as well. So if there was forwards, we could have used that, but here the choices were to take two. And the reason we haven't taken matching receipts and the payments is because there was no income in pesos. And the reason we didn't take leading or lagging is because it said in the question that the dates are set by the bank, which cannot be changed. That was 24. 25 now. 25 now. Zerona also trades with companies in Europe which use the euro as their home currency. In 3 months' time, Zerona will receive 300,000 euros from a customer. So now a receipt is coming in from euro, 300,000. Which of the following is the correct procedure for hedging this receipt using a money market hedge? What will be what was the payment? What is the receipt structure here? So let's go back to the receipt structure. So this was the receipt structure. Remember, in the receipt structure, we always borrow abroad and deposit home. We always borrow abroad and deposit home. So we'll borrow an appropriate amount in euros now. This seems right to me. Borrow an appropriate amount in dollars? No, dollar is home. We don't borrow in home in receipt. That's wrong. Borrow an appropriate amount in dollars now? No, that's wrong as well. So it's either this one or this one because both of them start with the right one, which is borrow an appropriate amount in euros now. Then the second is place the euros on deposit. No, we don't place the euros on deposit immediately. Instead, we convert the euros into dollars using the spot rate. So if you see the structure, that's what we do in step 2. Then place the dollars on deposit and use the customer payment to repay the loan. So this seems fine. The problem with this one is that after borrowing in euros now, they directly place on deposit, which is not right because step 2 is to convert using the spot rate. So this answer here is the right one. This is the right answer here, not the last one. Okay, so this is it on this question. So can I have questions first on this particular question? Can I have questions on this particular question now first? Any questions on this particular question? Questions time. So any questions on this particular question? Okay, so questions coming in. What are currency swaps? Currency swaps are basically where we swap the interest rate commitment with a foreign company, and the aim is to reduce the cost of the borrowings. So we swap the interest rates. We swap the interest that is paid on the borrowings, but in a foreign currency. And the aim is to reduce the interest cost. If I have time, I'll try to explain to you that with some diagram as well. In case of future, if we have sold futures early before certain future date, then either we are bind or not of the future. Well, if it is a legally binding contract basically. So futures are a legally binding contract, so they are not the options. So remember, futures are not the options. Options is where you have the choice to do whatever you want whenever. So if you have anything which you want to buy or sell early, you can do because you can option. Futures are legally binding. So you can trade them at a point, but it's not that you have a choice that you can buy or sell whenever you want. So that's it. Any other questions? So we still have some time. We have a few minutes. So I'm open to any questions at this point if you may have on things that we did today. Any questions you may have on things that we have done, I'm happy to answer at this point. So please feel free to drop the questions at this point. Okay, some general question. What you will recommend to student who fail in between 46 to 50? Well, for someone who has failed between 46 to 50, what you need to understand here is that uh, there seems to be a small area which is not working well for you. And based on my experience, I think it is usually the discussion bits which are causing a problem there. So I would say work on your discursive answers, because you will have about 15 to 20 marks, let's say. So somewhere between 15 to 20 marks maybe on the discussion bits in section C. And that is an area which is weaker sometimes for people sitting this exam. So work on your discursive answers, and again, see how I've done my first few sessions where I explained things well, discussed things well, showed you how to type in exam conditions, how to leave spaces and all. So just work on those points is what I would say. The thing with the numbers is that you will get own figure rule from the examining team. So if you made a mistake somewhere, you will still get some sort of a credit because the marks are for understanding and not getting the right answer. But the discussion has to be well. So that's what I would recommend. The next question here is, can you do the workings on the scrap paper for section A and B and just put the answer in the exam software and just answer section C in software so they can see the workings? Well, yes, that is what happens. So section C is what goes to the examining team for marking, and section A and B is automatically marked. So wherever you do your workings, whether those workings are done on a piece of paper or they're done on the scratch pad, these workings are not going with your answers. So you just put your final answer there in section A and B, and the section C answers should have the full workings in terms of the software, because they will then be forwarded to the examining team for marking. So section A and B, simply do the workings, put your final answer. Section C, do everything on the spreadsheet. So I hope that was that answered your question. Any more questions that you may have here? Any more questions at this point on things that we have done? Okay, another question here, that question regarding section B OT questions. Some of the questions ask for a number as the answer. Suppose your answer is off a tad bit due to rounding. Well, what I would say here is that it shouldn't be the case, because the examining team does understand that point. So what they always tell you is the exact number of decimal points at which you need to give your answer. So for example, today we did one question, it came out to be 112.01. If it was a text box question, then that is the only thing I'm getting out. I can't get anything else out. So the examining team knows that, and they will always create questions which think about this idea that what is the most comfortable point a student can reach in terms of avoiding any rounding complexities. So I would say just practice more and more on the software, the exam software, the response questions, the extra construct response questions, or the specimen exam, to get a feeling that how the examining team is using all that. So that is something you can do by practicing. Okay, so any more questions here? Any more questions? So I'm sure that you found this really useful. So thank you for being attentive audience, and thank you for being interactive audience as well. I really enjoyed the 4 sessions with you, and I hope that you're going to use these again for your final preps just before the exam. Please focus on the areas which I have mentioned here in terms of the questions. So there are some more questions which you can do. So I've taken more questions. which you can do. So we were able to do 40 marks on this webinar, and there are still some questions left here which you can do later. So please practice these questions. Also, the questions which I've highlighted on working capital, on business finance, and on investment appraisal were all really, really good questions. So if I was sitting this exam like you, I would be going into these questions and practicing them a lot so that I'm comfortable with the idea of doing these questions in exam time. So thank you for your kind comments. Thank you for the kind comments. And I wish you all the best for your upcoming exam. And if you got any questions, please feel free to drop me an email. I will get back to you as soon as I can. I will reply you back. So any questions related to the questions I've done on the revision webinar series, I am very, very happy to answer them for you. So again, wishing you all the best, and I will see you somewhere in the future then. Goodbye.